Wars, market and wealth creation. What smart investors do differently? Wars create fear. Fear creates volatility. Volatility creates opportunity. Every time geopolitical tension rises, markets react instantly. Prices fall, headlines turns negative, investors get panic. But here's what history clearly shows. Markets hate uncertainty, not bad news. And once clarity comes, recovery begins. Let's look at data. During the Gulf War, market corrected sharply but recovered within months. When Iraq war began, indices fell initially, then entered a strong rally phase. After the Russia-Ukraine war started, global markets corrected. Yet many major indices went on to make new highs within weeks. In India, the BSE Sensex has historically corrected around major conflict events, but typically regained ground once uncertainty reduced. Why does this happen? Because business continue operating, supply chains get adjusted, economies adapt. Growth does not permanently stop. The real risk here, the biggest misconception is volatility is not a risk at all. Emotional decision making is a risk. When investors react emotionally, they sell low, they re-enter late, they miss recoveries. Wealth historically has been created by disciplined investors who stayed invested through uncertainty, not who exited during panic. Patience is not passive, patience is a strategy. Current geopolitical context. Whenever conflict escalates, especially in oil sensitive regions, market immediately price in higher crude oil, safe haven demand for gold and silver, currency volatility, liquidity pressure. Short-term corrections of 5 to 10% are common in such phases. However, structurally, economic stories, particularly in emerging markets like India, are driven by domestic growth, corporate earnings, demographics, and capital formation trends. Markets react to headlines, but they rebuild on fundamentals. What this meant for investors during geopolitical shocks, defensive positioning becomes very much important. Asset allocation discipline matters more than prediction. Liquidity management is critical. Avoid leverage during decision during higher volatility. Corrections often reset valuations, and valuation resets historically have provided long-term entry opportunities, but only for those who aligned with their risk profile and time horizon. Remember, the market rewards discipline, not prediction. So, disclaimer is this video is strictly for educational and information purposes only. It does not constitute investment advice, a recommendation, or a solicitation to buy or sell any securities or financial instruments. So, uncertainty is temporary, discipline is permanent. When fear rises, strategy matters more than ever. Thanks.